Okay, for this mock exercise, we're going to take a look at another question on consolidation subsequent to the date of acquisition. And this question is two companies, Penn and Silk. So let's read the case facts. So Penn acquired 85% of Silk on December 31st, year one, for $646,000. So let's, as we read the question, let's put down what we know. So cost of 85% of the investment. And I always like to kind of indicate that P bought 85% of S, just as a constant reminder that that's the ownership structure. And this is for $646,000. Now again, the acquisition method in our standard requires us to calculate the implied value. The implied 100% value of Silk. And to do that, we're going to use the amount that we paid, $646, divided by 85%. That should give us the value for 100% of the business. Okay, now, this happened on December 31st, and Silk had common shares and retained earnings of $500,000 and $100,000, respectively. So let's write that down. So this is the shareholders' equity. I'm going to short form that SHE of Silk Company as at, and this is the date of acquisition, which is December 31st, year one. So common shares, CS, 500,000. Retained earnings, 100,000. To give us a net book value of 600,000. So now we can calculate the acquisition differential. It's called the AD as at December 31st, year one, for 160. Now, let's analyze the acquisition differential. What are we told? It says the imputed acquisition differential was allocated to $70,000 to inventory, with the balance to patent being amortized over 10 years. So we know that it's allocated to inventory, and we're going to use the FIFO basis, which means that we're going to recognize that acquisition differential of $70,000, and patent is the other asset. And this one has a 10-year life, remaining life, right? And that's the 90. So altogether, this is the 160. All right? Now, what we need to do is, you'll see that they gave us information up to the end of year three, and we're asked certain questions. Again, we're asked to compute certain information from both the balance sheet and the income statement for the end of year three. So we need to actually analyze and amortize these acquisition differential. So we need an amortization schedule, just like we did in the other problem. The amortization, first, list the balance. As of December 31st, year one, this is the date of acquisition. Now we had inventory here, and that was for $70,000, and patent for $90,000. So altogether it's the 160. So this always ties to the acquisition differential. Now, we know that this is 10 years, so it's 90,000 divided by 10. The amortization is 9,000 per year. Now, amortization for year two and year three. So we know that under the FIFO basis, we're going to amortize the 70. It's going to be recognized, adjusted to income in the first operating year. So that at the end of the year, the balance at December 31st, year 3, is 0. Now, there's amortization. Remember, the beginning, we bought it on December 31st, year 1. So we've got a full year amortization for year 2. And that is $9,000 for year 2 and $9,000 for year 3. And the remaining net book value of the unamortized is $72,000. So altogether, the adjustment to net income for year 2 is $79,000 and $9,000 for year 3, leaving us an unamortized acquisition differential of $72,000 at the end of year 3. Now remember, we saw in the previous problem that this is extremely important to get this schedule right, to get this acquisition analysis right, because it's going to impact our future balance sheet items. So I've done that. Now they gave us, it says that Silk reported profit of $30,000 in year 2 and $52,000 in year 3. While no dividends were declared in year 2, Silk did declare dividends of $15,000 in year 3. Now, Penn, on the other hand, uses the cost method to report their investment in Silk, and they reported profits of $28,000 in year 2, but they reported a loss of $45,000 in year 3. Okay, so the first part is compute the non-controlling interest for year 2 and year 3. So I'm assuming that they're referring to the profit, right? So NCI income statement. Okay, so for year 2, what was the profit again? The profit was $30,000. Now, what was the acquisition differential? In this case, the AD is $79,000. So we're going to take minus $79,000. So this is the AD amort, okay, to give us a negative $49,000. And we're going to multiply that by 15% because the non-controlling interest owns 15%. That gives us a minus 7,350. For year 3, we're going to take the year 3 profit, which is $52,000. We're going to adjust the AD, which is $9,000 from our AD schedule. That gives us positive $43,000, so it's an income times 15% to give us 6,450. These are your non-controlling interest income statement. Part B says, what is the profit, consolidated profit to Penn in year 2 and year 3? So Part B says consolidated net income. So how do we do that? So let's do a column, year 2 and year 3. We always start with the parent. So in this case, it would be parents' net income. In this case, it's Penn's. So we're told that Penn reported $28,000 net income in year 2 and $45,000 lost in year 3. Now, we're told that they used the cost method, which means that we need to deduct, adjust for dividend income from Silk. Because under the cost method, they would have adjusted their income or Penn's income by recording the proportionate share of dividends. So, year 2, there were no dividends declared by Silk. But year 3 there was, right? There was 15,000, but they got 85%, which is 12,750. So this would be 0, and this we want to deduct 12,750. So the adjusted Penn's income is 28, and this is minus 57,750. Okay? Now, we're going to add Silk's profit. So remember, we did this, right? We took Silk's profit. If you remember the first part, this is Silk's profit. Adjusted for acquisition differential. So we know that. So let's not recalculate that. We already know what that is. So year 2, we know that's 49,000 minus at 85% to give us minus 41,650. For year 3, we know that was positive 43,000 at 85%. Gives us 36,550. So this is the consolidated profit. And this is minus 13,650. And this is 21,200. So I wanted to kind of get you to think about that that number comes from here. And this number comes from here. Okay? Now, number 3 says, calculate the consolidated retained earnings at December 31st, year 3. Consolidate your retained earnings at the end of year 3. Again, we're going to take the parent's retained earnings, which in this case Penn's retained earnings at December 31st, year 3. And this is given to us, right? We are told that the ending retained earnings at the end of year 3 is 91,000. And remember, they were using the cost method. Now, we're going to, so there's no, now, if there were any intercompany transactions that remain unsold within the group, then we need to adjust this. But in this case, remember, we're dealing with only the consolidation process, and we completely ignored any intercompany transaction. So now we're going to take a look at the Silk's retained earnings. And this is December 31st, year 3. Now again, we don't have that number, but we can figure out that number, right? So we've got the acquisition retained earnings. That acquisition retained earnings was 100,000. So this is 12/31 year 1. And we're going to add the income, which is 30,000 less dividends, which is 0. So this is year 1. And then they had a income of 52 less the dividends of 15. This is year 2. And this gives us 167. Now, what was the retained earnings at date of acquisition? That was 100. That came from the case facts. So this is the increase in retained earnings since acquisition. Now, we need to adjust that with the year to date. How much amortization did we actually recognize? So it was 79 and 9, right, at the end of year 2. So we need to grab that number from our amortization schedule. So this is called the AD amortization. And we know that was 79,000 for year 2 plus 9,000 for year 3. And that gives us 88,000. And that is a minus because we need to reduce the income because there were fair value increments. That gives us minus 21,000. So let me just put a bracket in front of that. We're going to multiply that by 85% to give us minus 17,650 or 850, sorry. And the sum of that gives me 73,150. Now, you're probably wondering, and I would too, is this number, if you start with the parent retained earnings, doesn't this number already includes the dividends that was declared by Silk? So remember, Silk declared dividends in year 3 of 15, so wouldn't that be in this number? And why are we not adjusting it out of this number? Well, when we're doing the consolidated retained earnings, we don't need to adjust the 91 and take away the dividends because indirectly we're doing that through here. Remember, we're adjusting it out of here. So the fact that we're taking it out of here and we're only looking at the net change in retained earnings effectively adjusted for that, compensate for that dividend that we've recorded at 85% here. So by the retained earnings consolidation, we don't have to adjust any dividends that we've recorded that was received or declared by Silk on our retained earnings because indirectly we're actually also excluding it from here as well. Okay, so we don't want to be double counting it. Now, for perhaps when we're doing the consolidated net income, we had to adjust for it because we needed to make sure that our income is strictly represents income associated with outside transaction, external transaction. Okay, so next is we're going to take a look at the next part of the question. It's asking us to calculate the non-controlling interest on December 31st, year 3. So it's asking us for non-controlling interest for December 31st, year 3. So this is the balance sheet they're asking us. Again, very similar to what we did in the previous question. We want to know what the Silk's shareholders' equity at December 31st, year 3. We know that common shares, they didn't issue any more shares, so that would be the same as the date of acquisition. The retained earnings we calculated, didn't we? We know that the retained earnings was 167. We calculated the retained earnings of Silk from this analysis. So let's use that. That would be the net book value of 667. Now, we need to adjust the unamortized acquisition differential, and that would be this amount. So that would be the unamortized acquisition differential, and we need to add that to the investment to give us 739, and at 15% would be the non-controlling interest balance sheet as at December 31st, year 3. Now next it's asking us for investment in Silk had they used the equity method. So this one here is, what is the investment in Silk using the equity method at December 31st, year 3? So we've got the initial investment, which is 646. We've got the retained earnings at 12/31 year 3. This is Silk's. And Silk's retained earnings we calculated to be 167, didn't we? And that's the same number as this one. We're going to subtract the retained earnings at date of acquisition. So these are both Silk's. And that was 100,000 if you recall. So this will be the change in retained earnings since acquisition, right? Now, what was the purchase, what was the acquisition differential, the AD amortization? Again, let's go back to the AD amortization schedule. We amortized 79 and 9. So that would be 79,000 and 9,000. So that would be 88,000. So that gives us minus 21,000 at 85%. So this is very similar to, again, the retained earning reconciliation, if you saw that a bit earlier. And that gives us minus 17,850. Altogether, 628,150 is the total investment. So this is the investment in Silk at 12/31 year 3. Finally, it's asking us for the consolidated patent at December 31st, year 3. Well, that's not so hard to do, right? You can look at the schedule. You can look at the amortization schedule. Certainly, you can look at that. So you can see that that's 72,000 because that's what we had in our amortization schedule, 72. Now, there is another way of doing it, right? So let's see, I just want to see schedule here. Another way of doing it is how do we do that? Well, what was the investment in Silk using equity method? It's always equity method. At December 31st, year 3. What was it? Well, we know, we just calculated it, didn't we? It's 628,150. And this represents what? 85%, right? So what would the investment in Silk be at 100%? So let's think about that for a minute. So the implied value at 100% of the investment would have been 628,150 divided by 85%. That gives us 739. We're going to deduct from that the shareholders' equity of Silk at 12/31 year 3. And that was common shares, 500,000, and retained earnings, remember, it was 167. We calculated that too previously, 667. The difference between this two should be the balance of unamortized AD, which in this case is 72. So I just showed you a really neat trick to get to what the unamortized AD at the end of the year. In this case, it's just patent, but it could be goodwill. It could be a combination of goodwill and patent, but we know that the total is got to be 72. So the only way this will work is that we've got to convert the investment on the parent side and Penn side using the equity method. That's the key. It's the equity method, and that's the only way it would work. Then we know what that is. We calculated that in the previous question. Then we have to figure, okay, if that represents 85, we're going to take that and calculate the implied value at 100%, and that's what that 739 represents. So that's the investment at 100%. We subtract that from the net book value of Silk, shareholders' equity of 667, and that difference should be equal to the acquisition differential. Okay? Thank you so much.